This disaster didn't just happen. It was engineered. Meet Melissa Cartwright, 42, a high school math teacher in Phoenix, Arizona. In October 2024, she watched the value of her 3-bedroom suburban home drop by $186,000 in 12 months. The kitchen she'd remodeled with white cabinets and a farmhouse sink still smelled faintly of fresh paint, while her mailbox, filled with letters from her bank that started using words like margin call and forced sale. Melissa wasn't alone. By the third quarter of 2025, U.S. mortgage delinquency rates climbed to 3.99%, with states like Arizona seeing some of the sharpest increases, up 29 basis points in a single quarter. In the UK, more than 700,000 households faced mortgage payment shocks as their fixed-rate deals expired, with annual costs jumping by an average of $4,000 per household. In Canada, price declines left many buyers who purchased at peak prices underwater, with composite home price indices down 4% year over year in major markets. What happened wasn't bad luck or some mysterious invisible hand of the market. It was a slow-motion execution planned in boardrooms, approved in parliament buildings, and packaged as housing policy and financial innovation. The people responsible turned rising interest rates, exploding house prices, and household desperation into record profits and record bonuses, then blamed ordinary families for borrowing too much. And it gets worse and much darker. Picture this. It's 2015. Mortgage rates in the United States hover around 3.8%. A young couple in Dallas can lock in a 30-year fixed mortgage and actually believe that fixed means something. British families in Manchester and Birmingham take out 5-year fixed deals at 2%. In Toronto and Vancouver, real estate agents talk about buy now or be priced out forever. But the monthly payments still seem manageable on 2 decent salaries. Back then, the promise was simple. Work hard, buy a home, pay your mortgage, and in 20 or 30 years, you own an asset that will help you retire. The front lawns look healthy. The kids ride bikes in cul-de-sacs, and everyone has the same unspoken belief. The system might be unfair in many ways, but at least your house is safe. For almost a decade, the system appeared to work. From 2012 to 2021, U.S. home prices climbed in a near straight line, with the Case-Shiller index up more than 70%. In the UK, house prices in cities like London, Bristol, and Edinburgh doubled in just over 10 years, minting accidental millionaires who had simply bought at the right time. Canadian homeowners in Ontario watched their home equity fatten by hundreds of thousands of dollars on paper without lifting a finger. Banks extended credit easily, mortgage brokers got commissions, central banks kept rates near zero, and governments loved the illusion of prosperity. Home ownership became the anchor of middle-class identity and the main retirement plan for millions of people who no longer trusted pensions or the stock market. But cracks were appearing long before most people noticed. In March 2019, housing analysts started warning that prices in cities like San Jose, Vancouver, and London had detached completely from local incomes. In December 2020, a small group of economists flagged that more than 20% of new U.S. mortgages were stretching debt-to-income ratios to levels not seen since 2006. A handful of regulators in the UK and Canada complained that households were loading up on variable-rate mortgages to afford insane prices. They were dismissed as pessimists. Central banks insisted inflation was transitory, politicians insisted housing wasn't a bubble, and the public desperately wanted to believe them. Even economists were panicking quietly, which is rare because they're usually confused, not scared. The story everyone knows goes something like this. No one could have predicted how fast interest rates would rise. The official narrative says that after the pandemic, governments spent too much, supply chains buckled, inflation surged, and central banks were forced, reluctantly, heroically, to hike rates faster than at any time since the 1980s. According to this script, the Federal Reserve, the Bank of England, and the Bank of Canada had no choice. Between March 2022 and July 2023, the Fed rate shot from near zero to over 5%. UK base rates jumped from 0.1% to above 5%. Canadian benchmark rates followed. Media headlines framed it as an unfortunate but necessary fight. We must crush inflation even if it hurts. Officials like Jerome Powell, Andrew Bailey, and Tiff Macklem appeared on television repeating the same line, pain now, stability later. Homeowners were collateral damage in a noble war against rising prices. But that explanation has problems. It pretends the system was basically sound and just got unlucky with inflation. It ignores that central banks held rates at emergency lows for more than a decade, inflating the biggest housing bubble in history, while wages stayed flat. It skips over the fact that banks, mortgage lenders, and private equity funds pushed households into riskier products, adjustable rates, interest-only loans, HELOCs that would explode the moment rates moved. If this was just an accidental inflation fight, why were banks still issuing risky loans deep into 2022? when inflation had already blown past 7%. Why did real estate investment trusts keep buying entire neighborhoods with cheap leverage, knowing any rate shock would crush regular buyers first? A small group of skeptics, independent analysts, housing activists, even a few former central bankers, pointed out the obvious. You don't build a decade-long housing bubble by accident, and you don't pop it this violently without knowing who gets hurt. What actually happened was calculated. Low rates, easy credit, and housing wealth were used to keep consumption growing while real wages stagnated. Banks and asset managers extracted fees and profits on every step of the housing chain. Origination, securitization, refinancing, and foreclosure. Political parties in Washington, London, and Ottawa quietly discovered that rising home prices made voters feel richer, even as their real economic position deteriorated. When inflation finally forced central banks to hike, the people in charge knew exactly which households would get crushed. The ones who bought late, stretched hardest, and relied on variable rate loans. The timing, the products, and the incentives all lined up. Because the truth is darker. And this is where the story gets really suspicious. Take the United Kingdom. Between 2016 and 2022, British banks and building societies loaded millions of households into 5-year and 2-year fixed-rate mortgages at ultra-low rates, 1.5%, 2%, sometimes less. On paper, this looked safe. In reality, it was a ticking time bomb. In January 2022, a family in Leeds could fix a $280,000 mortgage at 1.8% and pay about $1,000 a month. By January 2024, when that deal expired, the same family faced refinancing at 5.5%. Behind the scenes, mortgage books were quietly structured to pass as much interest rate risk as possible to borrowers. Many loans included steep reversion rates, meaning that if you didn't or couldn't refinance, your mortgage automatically jumped to a punishing variable rate. Some lenders packaged these loans into mortgage-backed securities sold to pension funds and insurance companies hungry for yield. The complexity made it almost impossible for an ordinary buyer to understand the full risk. Regulators issued gentle guidance, but almost never hard rules. When the shock finally hit in late 2020 and through 2024, arrears and defaults began climbing. Yet bank earnings looked fine. Net interest margins expanded. The system was designed so that when the bomb went off, the blast would hit families in terraced houses and suburban semis, not the marble lobbies of Canary Wharf. It's like selling umbrellas that evaporate when it starts raining, then acting surprised people got wet. Now look at the United States. From 2013 to 2022, Americans tapped hundreds of billions of dollars in home equity through cash-out refinancing and home equity lines of credit. Lenders marketed it as unlocking your home's value. By 2021, as rates bottomed, banks and non-bank lenders pushed homeowners to roll high-interest debt into their mortgages, promising lower payments and smart financial management. A family in Las Vegas might refinance a $260,000 mortgage at 3% into a $330,000 one at 2%, paying off credit cards and buying a new truck in the process. On paper, they were fine, as long as rates stayed low and home prices kept rising. By late 2022, new originations at 6 to 7% meant anyone forced to move, divorce, or lose a job would be trapped. Private equity firms and institutional landlords saw the opportunity. Companies like Blackstone-linked entities and other large landlords spent the late 2010s and early 2020s buying single-family homes in bulk, financed with cheap debt. Their business model was simple. Bid up prices, rent to those priced out, and wait for the next downturn to scoop up even more stock from distressed owners. When borrowing costs surged in 2023 to 2024, ordinary homeowners with stretched budgets had no cushion. An unexpected job loss, medical bill, or divorce became catastrophic. Meanwhile, the institutional players had hedges, flexible capital, and armies of lawyers ready to turn foreclosures into fresh inventory. Here's how it all connected. For more than a decade, the housing system in the US, UK, and Canada was quietly rewired to transfer risk downward and profits upward. Central banks created the conditions with ultra-cheap money. Banks and mortgage lenders converted that into leverage and fee income. Politicians enjoyed a housing-fueled wealth illusion they could brag about in elections. Households, starved of wage growth and real security, were nudged into using their homes as ATM machines and retirement plans. Safeguards that should have limited leverage, stricter loan-to-income caps, tougher stress tests, hard limits on adjustable rate exposure, were watered down or implemented too late. The harsh truth is this: the modern housing system doesn't primarily exist to give you a stable place to live. It exists to manufacture streams of cash for financial institutions. And if 40 million people lose everything in the process, that's a market adjustment, not a crime. It's like watching someone juggle knives while yelling, "Trust me, I've got this." And then it all fell apart. It's Monday, March 3rd, 2025. U.S. mortgage delinquency data for Q4 2024 quietly drops on a government website. Analysts notice a sharp jump in delinquencies among borrowers who took out mortgages in 2021 and 2022. Financial media runs a few cautious headlines about rising stress, but markets shrug. By the first quarter of 2025, the delinquency rate for all mortgage loans climbs to 4.04%, with FHA loans seeing a 23 basis point year-over-year increase and seriously delinquent FHA loans jumping 80 basis points from the previous year. Florida shows a 46 basis point increase, with South Carolina, Georgia, and Delaware following close behind. Week 2. On April 2nd, 2025, the Bank of England publishes a report showing that more than 1.1 million UK households will see their monthly mortgage payments rise by over $500 in the next 12 months. That same day, a major UK lender quietly tightens its affordability criteria and cancels a popular fixed-rate product. Housing transactions freeze almost overnight. Estate agents complain of buyers vanishing. Sellers refuse to drop prices, still anchored to 2022 peaks. In Canada, similar patterns emerge. Rising arrears in Ontario and British Columbia, and a sharp drop in pre-approvals, with home price indices showing declines between 4.6% and 6% year over year. Month 1. By mid-2025, the 30-day mortgage balance delinquency rate surges to 3.68%, exceeding pre-pandemic levels. For Melissa Cartwright in Phoenix, the collapse doesn't arrive as a headline. It arrives as a letter. On August 7, 2025, her lender informs her that the low introductory rate on her hybrid adjustable mortgage is expiring. Her payment is going from $1,650 to $2,130 a month. Her salary as a teacher is $58,000 a year before taxes. Her ex-husband's child support covers groceries and after-school care. There is no extra $780 lying around. She calls the bank. The customer service rep is sympathetic but firm. The contract is the contract. By November 2025, Melissa has missed 2 payments. Late fees and penalties pile up. The Zillow estimate on her home, once touching $520,000 at the peak, now shows $334,000. She owes $412,000 on the mortgage. That's a negative equity hole of $78,000 and growing. The day a foreclosure notice arrives, her youngest son has a school project about home and family. She sits at the kitchen table doing the math she teaches her students, realizing the numbers don't add up for her own life. She will lose the house where her kids took their first steps, not because she gambled in some exotic derivative market, but because a system built on cheap debt suddenly decided her time was up. Across the continent, in Brampton, Ontario, Arjun and Priya Singh bought their first home in May 2022. It was a modest detached house for CAD $980,000 with a CAD $780,000 variable rate mortgage. By early 2025, local prices had slipped. Their home is now worth maybe CAD $820,000 on a good day. If they sell, legal costs, realtor fees, and penalties will eat what little equity they have. If they stay, each payment feels like pushing a boulder uphill. In their street, 3 for sale signs have hung for months, with price reductions scribbled in red on the agent's flyers. It doesn't matter if you're a teacher in Phoenix or a software engineer in Ontario, the pattern is the same. The promise was work, pay, own. The reality is work, pay, and when the music stops, the chairs belong to someone else. While Melissa and the Singhs are scrambling to keep lights on, the people who built this machine are doing fine. In 2024, the CEO of a major U.S. mortgage lender walks away with a $9.6 million compensation package, even as his company announces layoffs and higher default provisions. A UK bank that aggressively pushed 2-year fixed deals at rock-bottom rates reports a 28% jump in net interest income in 2025, bragging that repricing of the mortgage book boosted profits. Translation: your pain, their earnings, beat. In Canada, a large financial conglomerate quietly discloses that its mortgage losses are within modeled expectations. While boosting dividends, there are no perp walks. There are no televised hearings that actually change anything. Regulators issue sternly worded reports. Politicians promise inquiries. At most, a few fines are paid, amounts that represent weeks of profit. One executive, when asked about rising foreclosures, shrugs and says, "Our responsibility is to our shareholders." Some call it a housing correction, others call it a necessary adjustment. But if you strip away the jargon, what you see looks less like a natural disaster and more like a robbery wearing a crisis costume. And this is when the entire system cracked. It's Thursday, October 9th, 2025, 9:17 a.m. on Wall Street. Traders stare at screens as a major U.S. home builder issues a profit warning and its stock drops 38% at the open. In London, real-time data on mortgage arrears hits the trading floors of Canary Wharf, flashing red on risk dashboards. In Ottawa, a hastily organized meeting pulls senior officials into a bland conference room to discuss household vulnerability. In living rooms across North America, families refresh their banking apps, hoping their payment went through, hoping the next one will somehow be easier. For a few hours, the illusion holds. Then markets freeze. Buyers vanish. Liquidity evaporates. Everyone who thought they could just sell discovers that in a real downturn, there are only sellers. The world holds its breath. The panic spreads quickly. Emergency measures are announced, temporary refinancing schemes, whispered moratoriums on foreclosures, political speeches about protecting homeowners. Bond markets test governments. The cost of funding surges for weaker banks and lenders. Central banks hint at rate cuts, but inflation is still uncomfortably high, so they move cautiously. Each small intervention feels like throwing a cup of water at a house fire. Internationally, investors start dumping securities linked to mortgage markets, from U.S. mortgage-backed bonds to Canadian bank debt. The story turns global not because every country made the same mistakes, but because the same belief, that housing always goes up and debt is always manageable, was baked into financial systems everywhere. Then comes the reckoning. By early 2026, it's clear this isn't a soft landing. It's a reset. Housing construction slows sharply, wiping out jobs. Consumer spending drops as households prioritize mortgage payments over everything else. Governments face an unpleasant choice. Let the system purge itself and watch millions lose homes, or intervene again and reinflate the same bubble that just blew up. There are no easy solutions, only trade-offs. If money could scream, you'd hear it in every repossession notice, every auction sign hammered into a front lawn, every family loading cardboard boxes into a rented truck. The charts and policy papers don't show that sound, but it's there, echoing. But here's what everyone ignores, and it still affects you today. In the months after the peak of the crisis, the public is angry. Social media is full of videos of families locked out of foreclosed homes, of neighborhoods hollowed out by investor purchases, of politicians promising accountability. A few headline-grabbing lawsuits are filed against major lenders. Some result in settlements, $500 million here, $1.2 billion there. The numbers sound enormous until you realize the profits earned during the boom were many times larger. No major executive goes to jail. Most keep their bonuses. Regulators introduce new guidelines for responsible lending, but they apply mainly to future borrowers, not those already trapped. New regulations pass, but they often have more bark than bite. Loan-to-income caps are tightened. Stress tests are updated. In some jurisdictions, restrictions on foreign buyers or investor-owned properties are introduced, but the damage is already baked in. Homeowners who lost everything rarely get their houses back. Investors who bought foreclosures at a discount now hold even more of the housing stock. The system cleans itself up by transferring assets from the weak to the strong, then declares itself more resilient. Public anger fades as the news cycle moves on. Actual power structures barely change. Before 2022, the unofficial rule of housing was simple. Stretch as far as you can because prices will bail you out. After 2026, that rule is broken for a generation. Homeownership rates fall, especially among younger households. The share of homes owned by institutional investors and large landlords rises. In some U.S. metros, 25-30% of single-family homes end up held by corporate landlords. In parts of England and Ontario, renting becomes the default, not a stepping stone. The dream of paying off a mortgage and retiring on home equity quietly dies for millions. At the same time, financial firms adapt. New products appear, shared equity schemes where investors own a slice of your home, ultra-long mortgages of 35 or 40 years, rent-to-own programs that sound helpful but lock you into complex contracts. The wealth transfer is simple. People who bought early and sold high, or who had the cash to buy when others were forced to sell, end up with more assets. Those who bought late, stretched hardest, or relied on variable rates end up with scars and debt. The rules were rewritten, but not in a way that makes housing fairer. They were rewritten to formalize what was already happening. Homes as financial products first, places to live second. Even if you never miss a payment, the story reaches into your life. If you rent, you're competing with institutional landlords who can outbid you on any property and then set rents in entire neighborhoods. If you own, your property taxes, insurance, and maintenance costs are rising faster than your income, partly because local governments and insurers are scrambling to patch holes blown open by the crisis. If you dream of buying, the bar is higher. Bigger deposits, tougher stress tests, stricter lending criteria, all designed to protect banks, not you. In 2025 and 2026, wage growth in many developed countries lags inflation. That means every extra dollar you send to your lender is a dollar you don't spend building savings or investing in anything else. Meanwhile, housing has become even more central to political decisions. Governments quietly shape tax policies, zoning rules, and interest rate decisions around the goal of keeping home prices from collapsing too far, too fast. If you feel like everything in your financial life is somehow tied to your rent or your mortgage, you're not imagining it. The system made housing the main lever for controlling the economy, and you are the one being pulled. Here's the uncomfortable part. The pattern is repeating in real time. As 2026 unfolds, pressure is building in new places. Commercial real estate loans that never penciled out, private credit funds stuffed with risky debt, new housing markets in smaller cities inflated by pandemic relocation booms. Governments still depend on high asset prices to keep voters calm and tax receipts healthy. Central banks still walk a tightrope between inflation and collapse. The warning signs look familiar. Households spending more than 35% of income on housing, record household debt-to-income ratios, investors snapping up starter homes, lenders offering creative products to make unaffordable prices appear affordable. The narrative might be different, but the structure is the same. Gains are privatized, risks are socialized, and when the music stops again, it won't be the people in corner offices without chairs. What this really means is that housing isn't just about bricks, wood, and square footage. It's about power. Every major housing boom and bust in the last century follows the same script. Credit expands, prices rise. People are told it's safe. Then something snaps, and those closest to the money printer walk away with assets, while everyone else walks away with debt. In the 1930s, it was land and farms. In the 2000s, it was subprime suburbs. In the 2020s, its entire metropolitan regions caught in the crossfire between low rates, high leverage, and financial engineering. Finance isn't numbers. It's human behavior in a suit, repeated with better technology and bigger spreadsheets. The harsh truth is that no regulator, central banker, or politician is coming to individually rescue you. Their job is to keep the system running, not to make sure you personally win. Every crisis teaches the same lesson. If you don't understand how the game works, you are the product. When credit is cheap, you're encouraged to borrow. When rates rise, you're blamed for overextending. Losses are treated as your moral failure, gains as the market's efficiency. The story of 40 million homeowners on the edge isn't an accident. It's the logical outcome of a system that treats homes as chips in a casino and expects you to keep playing. So what do? You don't have to become a doomsday prepper, but you do need to become impossible to sucker. That means knowing exactly how vulnerable your own situation is, how much of your income goes to housing, how exposed you are to rate hikes, what happens if your income drops even 10%. It means being suspicious of any product that makes unaffordable prices look manageable. It means watching the signals that really matter: delinquency rates, foreclosure filings, debt-to-income ratios, and the quiet policy changes that shift risk back onto households. Awareness doesn't guarantee safety, but ignorance guarantees surprise. And if you think this story is insane, wait until you hear about how pension funds chasing yield in a zero-rate world helped inflate the same housing bubble that's now blowing up their own members' retirement plans.